Every Monday to Friday, this is Peter Lewis's Money Talk.
Money Talk.
Good morning and welcome to Super Tuesday. This is Peter Lewis with Money Talk for Tuesday the 5th of March. I have an analysis of today's top business stories coming up with my experts panel of guests. And this podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, China's top officials have gathered in Beijing for the annual two sessions. The 14th National People's Congress, China's parliament, will meet from today. At the NPC meeting, Li Qiang will deliver his first government work report since becoming premier, which includes the announcement of a country-level GDP growth target. However, China will scrap the customary press conference of the premier. Li Qiang will be the first premier in 3 decades to not hold a press briefing at the annual parliamentary meetings, removing a rare platform for investors to learn more about the nation's policy direction. The US presidential election primary season reaches a peak today as delegates in 15 states and 1 US territory vote for Republican and Democrat candidates on what is known as Super Tuesday. It's the biggest day of the nominating contests, with 874 Republican delegates' support at stake. Nationally, Donald Trump has a huge lead over Nikki Haley, the only other candidate left in the Republican race, and he is likely to face Joe Biden in the November election. Hong Kong's new home sales surged tenfold after the government removed measures to cool the property market in its budget last week. The city saw 117 daily sales of new homes in the 5 days since the curbs were lifted on February the 28th, compared with an average of just 11 in the 2 months before the policy shift. That's according to a report by real estate agent Midland Realty. The global equities rally extended into Asia on Monday, led by mega-cap tech shares. Japan's Nikkei 225 closed above the 40,000 mark to set a new record high. In Taiwan, the TAIEX index soared almost 2% to a record high, buoyed by a global rally in chip makers. The world's top chip maker, Taiwan's semiconductor manufacturing company, jumped 5.2% to its highest ever level since its listing in 1994, as investors piled into industries related to artificial intelligence. In India, the BSE Sensex index also hit a fresh record high, rising 0.1% to 73,872 and extending its record-breaking streak into a 4th session. On today's Money Talk, we're joined by Carlos Casanova, Senior Asia Economist at Union Bancaire Privé, Christopher Lee, Partner at Farron, Augustine and Alexander Investment, and our US Economics Correspondent, writer and broadcaster, Barry Wood. And as always, if you want to get in touch, please go to my website, peterlewismoneytalk.substack.com. And while you're there, take a look at my daily newsletter with updates from around Asia.
Peter Lewis's Money Talk.
On Wall Street Monday, US stocks reached new intraday record highs before giving up their gains. The S&P 500 shed 0.1% to close at 5,131. The Nasdaq Composite slipped 0.4% to 16,208. Both pulled back after notching a new record last week. The Dow lost 98 points, or 1/3% to end at 38,990. Chip makers were the biggest gainers in the S&P 500, continuing a global rally in semiconductor shares. Nvidia rose 3.6% on Monday to a new all-time high, giving it a valuation of $2.13 trillion. Intel and Advanced Micro Devices closed 4.1% and 1.3% higher respectively. Supermicro computer stock, that rose another 18.7% overnight to a new all-time high. This comes after Friday's announcement that the company will be joining the S&P 500, and the stock is up more than 300% in 2024 alone, at 1,000% over the last year. The yield on the 10-year Treasury note climbed 3 basis points to 4.33%. The US dollar index was unchanged around 103.85. Spot gold prices jumped above $2,100 an ounce for the first time since December the 4th, 2023. Bullion settled 1.6% higher Monday at $2,117 an ounce, and it's also now just under 1% away from a new all-time high. Oil prices gave up some of Friday's 2% gains to settle lower, despite OPEC and its allies extending their 2 million barrels a day voluntary production cuts until the end of June. Brent crude oil settled 0.9% lower at $82.80 a barrel. And the price of Bitcoin edged closer to an all-time high. The cryptocurrency was last up by just under 10% at $67,910. It's sitting about 1.6% off its November 2021 intraday record, which was $68,982. Chinese stocks eked out meagre gains as traders waited for the 14th National People's Congress, which begins today and could produce more stimulus measures to shore up the economy. The Shanghai Composite added 0.4% to 3,039. The Hang Seng finished almost flat at 16,596 on Monday, after trading slightly higher in the morning session. Futures markets pointing to a decline of about 110 points for the Hang Seng at the open this morning. Should start the day around about 16,485, and you can get more details on the latest market movements in my daily newsletter at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
And let's welcome our Tuesday morning guests. We have with us, first of all, Carlos Casanova, Senior Asia Economist at Union Bancaire Privée in Hong Kong. Morning, Carlos.
Very good morning.
And also with us is Christopher Lee, who is Senior Partner at Farron, Augustine and Alexander Investments. Morning to you, Chris.
Good morning, Peter. Hi.
And of course, on a Tuesday morning in Washington, D.C., we find our US economics correspondent, Barry Wood, hopefully celebrating the arrival of spring as well as Super Tuesday.
Oh, that would be so nice. We've had a cold winter, not a lot of snow, but it's been cold. But good morning, Peter.
And good morning to you, Barry. China's top officials, they've gathered in Beijing for the annual two sessions. It began yesterday with a meeting at the 14th National Committee of the China People's Political Consultative Conference. That's the country's top political advisory body. The 14th National People's Congress, which is China's parliament, is going to meet from today. And at the NPC meeting, Li Qiang will deliver his first government work report since becoming premier, which includes the announcement of a country-level GDP growth target, we hope. Economists are expecting officials to set a growth target of around 5%, which is the same as in 2023. And the report will also set targets for monetary and fiscal policy this year. But on Monday, it was announced that China's going to scrap the customary press conference of the Premier, who is the country's number 2 official, at the end of each annual session of its parliament, starting this year, and for future parliaments as well. Li Qiang will be the first Premier in 3 decades to not hold a press briefing at the annual parliamentary meetings, and that removes a rare platform for investors to learn more about the nation's policy direction. Maybe, Carlos, I can kick off with you. We're obviously expecting the NPC to reveal a long-term plan for trying to get the economy back into growth and tell us what their priorities are. What do you think we're likely to hear? Are we going to get that, do you think?
I think we are going to get a mixed bag, to be honest. A lot of expectations have been placed on this NPC sort of delivering a big bang of stimulus measures plus long-term structural reforms that will land China in a much better place. And I think that it will partially do that. But remember that it is not really the platform for this kind of thing. Although they do occasionally announce something, mostly what they do at the NPC is reveal what the targets for the year are and set up a very vague policy tone for the remainder of the year. So we think it's going to be that. We think that the 5% GDP growth target, which is, of course, what the average of all the provincial growth targets came out to be, is very ambitious. So, of course, some of the wording will have to be around monetary support, but especially fiscal support. So we could get a surprise there in terms of bond issuance. We think also that they will sound a more muted tone on inflation, which, of course, means that the central government is still very cognizant of the difficulties in promoting domestic consumption, and where we could get potentially somewhat of a surprise in terms of structural long-term reform, something that will sort of wedge the gap between consumer-led growth and the previous growth model, is with what President Xi has called new productive forces. So this is essentially how to invest more in new technology sectors and other growth leading sectors like EVs to ensure that China is still safeguarding some, export market share and some investment into manufacturing to sort of ease the transition towards consumption. So I think that is perhaps where we might see some surprises on the structural front, and we can of course discuss that further.
No, and normally by now we do have an idea of the economic priorities, don't we? Because the China government would have had the 5th plenum at the end of last year. That would have fleshed out quite a lot of economic policy, but that got cancelled. So we're sort of left rather in the dark, aren't we, at the moment, going into this MPC meeting?
We are, and there's been a lot of speculation around why that may have been the case, ranging from President Xi no longer prioritizes economic reforms, and so if you're in that camp, you are going to think that nothing is going to come out of the MPC. But I think more likely than that, they just haven't been able to iron out some of the differences in terms of what to prioritize with some of the more traditional views within the Communist Party advocating for consumer-led growth, which is essentially common prosperity. It's sort of the proven path that they have to deliver. But President Xi himself possibly pushing for a hybrid approach where they try to boost consumption, but simultaneously try to support also some areas of manufacturing. So they're not getting rid of this investment-led growth model entirely right now, but they're going to try to boost consumption while they continue to focus on investment in some areas at the same time.
Chris, what are your thoughts on this? Do you get the impression that maybe the Chinese government is not totally clear about what its priorities ought to be, or maybe how to achieve them? Because there is a sort of a worrying silence, isn't there? And that's combined with the cancellation of the press conference as well, although it was always stage managed with sort of planted questions. Nevertheless, it was an opportunity for the Premier to sort of like set out his vision, which Li Keqiang used to do in the previous parliament. But obviously we're not going to get that now. So what's your assessment of where we are?
We're not going to get that platform. I mean, as you said, Peter, these are all staged and prearranged. And so there's never going to be like the live Q&A that we're so accustomed to seeing in the Western world. So canceling this conference is not really something that I think we will really lose something material. However, I think there is, as you pointed out, that still issues that's still not clear. And especially, I think, from foreign investors' point of view, there is a deficit of perhaps trust, and also there's a deficit of confidence. So I think just a few months ago, when Carlos and I were talking to one of the mutual fund managers visiting Hong Kong, and the mutual funds, I think, analyzed the corporate earnings and seeing that 2023 and 2024 actually have positive corporate earnings growth, right? Even to double-digit level. However, what you're seeing is a derating of the stock market valuation. So there is quite a bit of a disconnect between the actual growth of the economy, especially in corporate earnings, and also what is reflected in the stock market. And as we know, the trust has to be there for investors to jump in and buy shares. And so other than just what is, I think, lacking in trust and confidence in the stock market, I think the property sector is another area for further, I think, improvement. So I think those are the two drivers that would probably help the Chinese economy and also the stock market to have more upside potential in the near future. So that's my take on it.
And if we don't get the details that investors are looking for, we're going to see maybe some more disappointment in the market. I think investors, they want some details, don't they? Just what is going to be done and how is it going to be done to try and get the economy back on track, back into growth?
Correct. Yeah. So, I mean, we've seen last month in February, we've seen Chinese officials cut the triple R already. So that was early part of February. And also, I think the average down payment, right, for an average new home is still about 30%, right? And that is pretty high bar for a lot of people. Think back in the US many years ago, the average down payment was like 2% of the purchase
yes.
of homes, right? Right? You know this, Barry. So, I mean, there's a lot of room for reduction in terms of what is the required down payment, and that would potentially stimulate the home purchasing and also the activities in the market. And so there are still tools that the Chinese government have in terms of like perhaps reducing interest rate. And, that's one big thing that they could do to stimulate the economy, and also perhaps letting the RMB devalue. And so that could help more exports, right? And also perhaps attract more foreign investors into buying Chinese equities. I mean, look at what happened to the Japanese equities market when the yen was at 150, and look at what happened last year, right? So many people enjoy going to Japan and having a, really nice meal for only $20 per person. And it's a great bargain. So I think these are tools that they still have, and they will probably be slowly rolling out some of these initiatives.
Okay, Barry, this is obviously going to be important, not just for China, but for the US and for the globe, really. What happens to the Chinese economy and the measures they come up with are going to be important for the US as well. What are you looking for sort of over there in terms of things that are going to have an impact on the US?
Well, I don't have a clue, and I don't think anyone really does. But I do think that what Chris was saying about the renminbi, if the renminbi were to depreciate, and that whole idea of China exporting deflation, that would drive down prices in the big bucks U.S. retailers. And that would be welcome. I don't think anyone would be cross in the administration with that either. But I think that when Chris speaks about, you could cut the interest rate. The question that I see increasingly in the pages of the Wall Street Journal or the FT or the New York Times about China is, how do you reinstill confidence among consumers? And I guess that's the question that I would put to Chris and to Carlos. How will the government succeed in doing that?
Yeah, well, the first step is that...
Carlos, do you want to go first?
Yep.
Yeah, just to Barry's point, the first step is deciding that is what you want to do. That has been a big question and a big headache for analysts looking at China for the past 12 months. It is not clear from the direction at the central government level that is what they are going to do, given that they are trying to balance the dual objective of boosting manufacturing and consumption. Those two don't go hand in hand. So I think a sign that they are going to look to sustain consumption at the MPC is already going to be great in terms of providing visibility for domestic consumers.
Chris?
I don't know if, Chris, you had similar thoughts or something else.
I have, a thought that is very unoriginal. I mean, I'm the only Hong Kong guy here, so clearly I'm not biased, right? So, I mean, I think the rising star, right, is going to be Hong Kong. I mean, I'll give you three reasons for that, right? One, I think we have seen the Hong Kong government eliminating the property taxes, so there's no more SSD, no more special stamp duty, and no more BSD, no more buyer's stamp duty. So you mentioned earlier that the home sales, right, in Hong Kong have increased almost 10 times just within a very short period. So having that, I think, uplift in the property market is going to help Hong Kong. And then secondly, I think Hong Kong is where you see most of the foreign investors, right, investing in Chinese equities, because the domestic A-shares market are obviously more restrictive, and Hong Kong is where you see most the foreign investors. So when the confidence is back in Hong Kong, I mean, we talked about the deficit of trust and deficit of confidence, but when confidence level is high up here in Hong Kong, there will be more, I think, interested investors buying in Hong Kong. And then thirdly, I just wanted to say that, we know from early 2021 to now, in the last 3 years or so, the Hong Kong stock market is down almost 60%, right? So that is a very big number, 50 to 60%. Now, those of us who are old enough to remember this, I mean, the last time that we saw this type of decline was back in 2000, 2003, the burst of the internet bubble. And then again in the 2007 to 2009, sort of like GFC. So, I mean, from a valuation point of view, this is now a very attractive time to actually enter the Hong Kong equities market. So there must be investors who are really wanting to come into the Hong Kong market. So, I mean, those are the three reasons why I think that Hong Kong could potentially give China a boost, the property and also the valuation and also the presence of foreign investors here.
Okay. Carlos, let me ask you about the 5% growth target. That's what people seem to be hanging their hats on as the number that's going to come out. It seems to me it's a bit of a problem for the leadership, because this 5% is going to be hard to achieve this year, isn't it? Because there's not the benefit of the base effect that we had last year, where you're comparing it with the period when China was in lockdown. So it's going to be harder to get that. And at the same time, presumably if they come up with a lower target, then the markets are going to be disappointed.
Yes, I totally agree with you. I think they cannot win on this one. Just to give you an idea, the growth number last year, the headline number was 5.2%. But as you mentioned, there was a base effect surrounding the lockdowns in Shanghai a year before. So if you strip away that base effect, our estimates point to a much lower growth rate of 4.1%. So 5% entails going from 4.1 to 5%. In the absence of massive monetary and fiscal stimulus support, I think it's going to be very challenging for the Chinese government to achieve that number in 2024. Moreover, I think it distracts from the key objective here, which is pushing structural reforms and stabilizing the housing sector. So in my opinion, the lesser of the two evils would be to disappoint the market with a more ambiguous GDP target. They have deprioritized GDP targets in the past. During COVID, they scrapped it altogether for that year. I don't think they'll do that again this year, although President Xi probably wants to. But I cannot rule out the possibility that they announce a band which is lower than what the market is currently expecting. It's just a possibility that we could see at the meeting today.
And I presume the possibility of stimulus, big bazooka stimulus being rolled out is not very high.
So my current forecast for this year is 4.5. So clearly I don't think so, or I would be at 5%, right? I think that on the fiscal, yes, we are probably going to see a much larger number in terms of special bond issuance for infrastructure. There's been a deluge of onshore voices, so a lot of the onshore brokers calling for more fiscal support measures. Some of them are going as far as saying China should implement consumption vouchers. So I think on the fiscal front, we still have a lot of room. Monetary, however, in the absence of a change to the exchange rate regime, currently the yuan is, at the weakest point it has been since 2007 still. If they want to devalue further to ease monetary policy, that would entail currency devaluation. They have to announce changes to the exchange rate regime. And that is a big if. So I think they will continue to proactively manage liquidity, do RRR cuts, do daily open market operations. By the way, there's a lot of room to provide liquidity to RRR cuts, so perhaps they don't even have to do universal rate cuts this year at all. But we don't expect a big bazooka in terms of quantitative easing unless they do announce changes to the exchange rate regime as well. So that means that the onus of support falls on fiscal, and of course it will be more challenging to hit 5%.
Okay. Chris, tell me a little bit about what the leadership means when they're talking about boosting new productive forces. This is a term that's come into the lexicon recently at the top levels of the government. What are they referring to here, and what are they planning to do?
So my guess probably is the same as your guess, is just to give people more productive jobs, and also so that they can go on and produce things, right? So one thing that I think some of us might have noticed is if you go to the top 10, top 20 cities around China, you see many, many unfinished buildings and residential apartment blocks that are just kind of like halfway built and it's not finished, right? And the main reason for that was for new home sales, people actually have to make payment like 18 months in advance. I mean, that's how some of the property developers receive their funding in developing all these residential units. And the reason why all these units are unfinished is because right now they're not getting new home sales. And so nobody is putting down money to buy any new homes. That's not one problem. And I think one of the tools that the government has is to direct the state-owned banks to provide more financing to these developers so that they can finish building out these apartments and then sell them in the traditional way, which is like, okay, I have built an apartment, and Barry and Peter, would you like to come and put down your 10% and buy them instead of, paying in advance 18 months before the units are built? So I think this would be another tool that we have in terms of just boosting the trust and also the confidence in the domestic market, because nobody wants to see a lot of unfinished apartments around, and that really hurts the confidence and the trust level.
I think, Barry, also one of the things they're talking about here with new productive forces is things like new sort of export categories like electric vehicles, lithium-ion batteries, solar cells, those types of things that the government thinks it can rely on going forward, and particularly to make up for the loss of growth in the property sector. But I guess this is where geopolitics comes in, isn't it? Because China can't absorb all this capacity. It's going to want to export it abroad, and the US doesn't seem to be very willing at the moment to accept any more exports in those sectors.
Well, you're right. And I think that's exactly where the administration is at. I mean, they do not want to see Chinese electric vehicles in the U.S. market. It's that simple. And, if they were to come in, they're going to pay a 27% tariff. I mean, that's what you would get. That's why you want to build a plant in Mexico to benefit from the free trade North American agreement. It's interesting that Stella Lee, who is the vice president of BYD for North America, says that, yes, we're going to build a plant in Mexico, but it's going to be so far south, it's only for the Mexican market. And we haven't even chosen a site yet. And this is what Tesla is doing. Tesla is building a plant, and I think they've already started construction near Monterrey, which is built clearly for the U.S. market and a lower priced car. So China would run into a stone wall if they think that solar panels and electric vehicles will enter the United States, North American market, or the European market without all kinds of problems. And this gets to what you just said, Peter. This is the geopolitics of this problem. So that, in my view, is not going to be a way out for China.
Out of interest, why is the take-up of electric vehicles so much lower in the United States than in China? I mean, it really has taken off in the domestic Chinese market. It's turned into a very cutthroat business as well, where all the manufacturers are trying to undercut each other. But it doesn't seem to have taken off in the same way in the US, sort of acceptance of electric vehicles and consumers wanting to go out and buy them.
Correct. I think there are multiple reasons, Peter. One would be that people don't respond well in the United States to government directives. And nobody would be buying electric vehicles except for the environmentalists without this government edict. And that government edict has promoted General Motors and Ford and Stellantis at the sake of Tesla, which is, 80% of all electric vehicles are Teslas, but they're non-union. So that didn't fit for the Biden administration. We're coming off the North American winter. A lot of these vehicles didn't perform well, the electric vehicles, in the winter and very cold temperatures. So right now we're in a lull where people don't want the whole buzz now about electric vehicles is way down, probably at its lowest level in 2 or 3 years. And I think a third problem is that we don't have the charging facilities. And, you see pictures of vehicles lined up to get into charging and, 30 minutes. And by the way, if in an electric vehicle you run out of charge, bad luck if you're not near a charger. And there's not something you go into the boot and get a quick charge. You can't. So I think the electrical boom, the bloom is off the rose. And I don't think it's going to happen. But that is a long-winded way of saying I think that's why the take-up rate for electric vehicles in the States is so low.
Because that's where we had a comment yesterday from one of the suppliers saying that basically, the Chinese manufacturers are really way ahead of everyone else in Europe and the US in terms of the quality of their vehicles and what they're doing. But you would think that some of these big manufacturers like Volkswagen in the EU, like Stellantis in the US, would be able to churn out good quality cars.
Yeah, and I think they will. I mean, those plants in the South that are going to be, Volvo is in Charleston, is going to have a good electric car, but the electric car is not popular at the moment, and there would have to be a stronger government edict about the shift to electric cars. And by the way, the only reason we're doing electric cars at all is because of government edicts and the tax breaks that have come to consumers. So it's very interesting. You mentioned the quality of the Chinese cars. I didn't think we're going to see any Chinese cars in the U.S. for another 12 months. And, people will buy them if they're cheap. But the administration, the Biden administration is really against that. And don't forget, there was a big UAW settlement, the Auto Workers Union, back in October. And General Motors, Stellantis, and Ford are all cutting back on their investment in electric cars. So this is not a good time.
Carlos, I suppose one of the problems for China is that these new areas that the government wants to promote by edict, in effect, things like electric vehicles, batteries, lithium-ion batteries, solar panels, the sectors are just not big enough to make up for the loss that we're seeing in the real estate sector to the economy. So presumably, even if they do come up with some policies to promote those sectors, they've still got to deal with what they're going to do about the real estate sector.
Correct. So to the previous point, I think we should also keep in mind that China has been throwing a lot more money at EVs than any other government in the world. So you do have, support measures for EVs in the US and Europe, but they pale in comparison to what China is spending. I think when we looked at it, it was about 3% of GDP on tax subsidies for the purchase of EVs, but also for the deployment of the grid, so the charging infrastructure. And this is actually one of the few areas where you have good data in China. This is something you can track on a weekly basis. So I think the government government-led drivers behind the emergence of the sector are quite huge. And going forward, it will be, for investors, it will be which companies will be able to safeguard their profit margins by going global, and in which areas. But to your point, are they a big enough chunk of GDP to offset the downside on the housing sector? I personally don't think so. I know some of the other commentators on the program have mentioned that given the contraction in the housing sector over the past few years, they are already bigger. But from my standpoint, housing is still about 20% or 17%, both directly and indirectly. And these new sectors, including EVs, green energy, they're only about 12%. So it will take at least 5-10 years before we are in a situation where the upside from the new sectors can offset some of the downside on the housing sector. So I think it will be paramount for the leadership to engineer a soft landing of the housing sector in the second half of this year, and hopefully and hope for Chinese consumers to take that as a sign that there's light at the end of the tunnel, and that will hopefully trigger a normalization in consumption. What we have seen so far this year is double-digit growth in services. We saw very strong data coming out of the Chinese New Year holiday, especially within travel and hospitality. But what we are not seeing is Chinese people buying, more consumer goods, more electronics. And so what we want to see is a broadening of that consumption away from services towards goods as well in the second half. Hopefully that is going to offset some of the slack from the housing sector. New economy sectors are just, there as a spare wheel and as a future growth catalyst, much like, tech was for the US, post global financial crisis, but the economy still had to go through a correction period.
Chris, there's got to be something said about the real estate sector, really, hasn't there? They're not obviously they're not going to discard the 3 red lines policy, but I suppose what investors are wondering is what sort of support could be provided for the real estate sector. What would you like to see?
Well, back to this big topic of real estate, right? My favorite topic. Again, I think as the new sectors like EV could help But again, I mean, I agree with you and Carlos that the focus is still going to be on the real estate. So if we look at the new home sales figures, right? So clearly, I think 2022 to 24, 2023 to 24, you see a significant drop in terms of pricing in the new home sector. But however, if you look at the existing home sales, secondary market sale of existing home, there's actually an increase in terms of the price on a per square meter basis, right? So, I mean, our analysts have also looked at this, and when you net it all out, there are more secondary home transactions than new home sales. So there is a net increase in terms of renminbi per square meter. So that's a positive news that we're seeing here, right? And then to respond to your earlier question about why is EV not popular in the US, I mean, again, I think the US is a very big country. There's a lot of diversity, and East Coast is very different from the Midwest and from the West Coast. And on the West Coast, we all saw how excited Gavin Newsom was when he visited Shenzhen, and he wanted, to test drive a BYD. And there's a market for that, right? I think economically speaking, it makes a lot of sense. And technically speaking, people also love the products. But as Barry pointed out, this is a political issue. And this last week, I think Biden just issued, a White House press release to say that they need to study the connected vehicles, right? And he's directed the Secretary of Commerce to investigate into the risks of having Chinese-made electric vehicles on the roads. So this is more than just technical and engineering and economic discussions. This is now a political discussion. So, I mean, I would say that in order to, rely on the new sectors, I wouldn't really put my money on it, but I would definitely look at the real estate sector in China and having the secondary home price go up. And that would probably be the near-term solution in popping up the confidence that we are lacking and also the trust that we have in the domestic market.
Barry, is this investigation into connected vehicles, is it purely political, or are there really genuine concerns about, these cars acting like smartphones, collecting data and sending it back to China?
Well, I think Carlos, yourself, and Chris have a much better sense of that than I. I know simply that Tesla is a huge collector of data, and that is one of the whole self-driving phenomenon, is the data that they have. So if you're having a Chinese, a BYD vehicle in the States, I mean, the question would become, where's the data going? If it's going to China, then you run into the China Data Protection Act. This is complicated. I shouldn't say anything more because that's all I know. What do you fellows think?
Carlos, it's certainly the case, isn't it, that China's concerned about things in reverse? I mean, they've banned, some government departments from having Teslas. So it seems to be the case, certainly in reverse.
Definitely, data is a new commodity. There's, I think, emerging regulation around the use and the storage of that data, and EVs do collect, data in terms of location, and we don't even know if they're collecting data in terms of what you're saying inside the cabin. So this is a valid concern, true. I would say.
Chris, this is going to be the new battleground, isn't it?
The new battleground is the political arena. And remember 30 years ago when Bill Clinton and these people came out, and it was the headline, "Is the economy stupid?" And 30 years later, I'm hearing that it's politics stupid.
That's certainly the case. Well, Barry, on the topic of politics, can you tell us a little bit about Super Tuesday? This is the big day, isn't it, where we get a lot of states voting at the same time. I think 15 states, one US territory, voting for Republican Democratic candidates. Is it all going to be over by the end of today?
I suspect the answer is yes. It will all be over. But there's 6+ months before the election. I think the best line I've heard was a pollster who said, looking at the two leading candidates, whichever one were to drop out for whatever reason, that party would win the election. And I think there is truth to that. There's no excitement for Mr. Biden. And there's not that much excitement for Mr. Trump. But Miss Haley is the big wild card here. If she gets 20%, she won't win anything on Super Tuesday. I think that's to be expected. And in fact, she doesn't expect to win. But does she get 20% plus, which would be something she could say is positive? She got 40% in New Hampshire, 40% in Iowa, that kind of thing. So she's finished as a Republican candidate. But will she endorse Mr. Trump? I don't think anyone has a clue. And much can happen. I'm thinking of that phrase, there's many a slip between the cup and the lip. I just think it's impossible to predict what's going to happen. But the short answer is yes, those two older men will be the people headed for the nomination.
And what is the significance of the Supreme Court decision to allow Donald Trump to be reinstated on the Colorado ballot? But also, I think they were saying that states don't have the right to kick presidential candidates off of the ballot. It's got to be done by Congress. Is there significance to that decision? Does it benefit Mr. Trump?
Yes, there is. And it does benefit Mr. Trump because, look, you've got a 9-0 decision. So even the liberals in the court say, oh, the state can't come along and say, we don't like you, which is really what you're talking about, because you can't invoke a confederacy against the Confederacy statute from 1867 as a reason to keep Mr. Trump off the ballot in Colorado or Maine. So, yeah, it's a plus for Donald Trump. But as listeners know, he's got a lot of other problems.
Carlos, I know the election, the US election is 6 months away, but from an economic perspective, are you starting to think about the implications of a Donald Trump victory and he becoming the next president, and in particular what that could mean for Asia and some of the economies out here?
Absolutely. I think that was one of our themes for this year, in fact. So we have been giving the possibility of a Donald Trump return quite some thought. The immediate sort of reaction is that it entails a return of volatility. And so there's a big theme around volatility-linked structures and the performance of those in the case Trump returns, but of course also, safe havens. So we are seeing already some upside on things like gold, like Swiss franc, and then even Bitcoin making a comeback with expectations of Fed rate cuts and also more volatility in government. So I think definitely volatility will be the name of the game. In terms of what that means for Asia, we are not sure yet. But interestingly, during Trump's tenure, the Chinese equities and the S&P delivered similar returns. So Trump is not necessarily bad for Chinese assets, but of course he did set the stage for Biden to come in with much more punitive, much more targeted measures, and it's likely that Trump will continue or extend that. So there's not going to be much of a change in terms of the China policy between Democrats and Republicans, or Biden and Trump. So, to your point, I think in terms of Asia, we are just not going to experience much of an upside from Trump, even though some Chinese commentators are hoping that Trump wins because he's pro-business and he was good for China. I don't think that's going to be the case.
Chris, what are your thoughts? I mean, the thing is, we're in a very different economic time, aren't we, from 2016 when he last won the election. So it's very hard to compare this period back then. But do you have any sense of what a Trump presidency could mean for Asia in particular?
I do. And economically speaking, I would limit my comments on the, investors' perspective. I don't really think whether a Democrat or Republican president is going to impact the investment climate in terms of investing in Asia or particularly in Chinese equities. The reason for that is you see almost like a unanimous bipartisan sort of like effort between the Democrats and also the Republicans in terms of their anti-China rhetorics, right? I've never seen this type of like bipartisan effort. And there's almost like a competition between the Democrats and also the Republicans, like who can be more tough on China. And so recently you probably have heard that there was a limitation in terms of U.S. investment into a Chinese venture capital company called IDG Capital. I mean, this is still being debated, right? But I think this is the extent to which the current Biden administration is limiting the U.S. investors from putting money into Chinese investments. So whoever wins, we know that it's going to be a rocky road and it's going to be volatile, as Carlos mentioned. But it doesn't really change fundamentally that the total sort of lack of confidence and the lack of trust by domestic Chinese investors in domestic investments. So I think it doesn't really affect the investors here in Hong Kong. And it is a political exercise that we're seeing in Washington, D.C.
Okay, Barry, just finally, I just want to get your thoughts on the markets. We're seeing this huge surge in markets all around the world at the moment, in the US, in Europe, out here in Asia, coming basically because it's being fueled by liquidity, isn't it? We've got this, the Fed running down its balance sheet, but at the same time, you've got the US government spending about $22 billion more than the Fed's balance sheet unwinds. So this liquidity is finding its way into all sorts of things, the stock market, Bitcoin, gold. But I just wonder how long this can go on, that there's this sort of deficit spending.
Well, no one has the answer to that one, Peter. But it is true that the gains in the market are broadening. You're seeing some real volatility in some of the tech high flyers. Probably NVIDIA is a bubble. But who's going to argue with record unemployment? Record low unemployment, a booming stock market, 3% growth, interest rates positive for the first time in 20 years. So things look good over here. And I don't see any sign that the stock market is going to go into a deep correction.
Carlos, let me get your quick thoughts on it. I mean, the Fed is basically printing money, isn't it, to buy all of this newly issued treasury bonds, all this debt monetization, and that's fueling this global liquidity in all sorts of assets, Bitcoin, gold, stocks, everywhere you look at the moment. But it all seems to me rather dangerous.
Mm-hmm. I think liquidity is definitely one of the factors behind this synchronized rally in equities. There are idiosyncratic factors in the different regions. So Japan has its own thing going on with the governance reforms and the weaker JPY. Within the tech sphere in the US, I think we have to understand that in addition to there being a lot of liquidity in the system, we are seeing very strong double-digit earnings growth. So arguably, that should justify high valuations as well. And if this post-COVID trend continues, then those earnings are justified. So that's why we don't see an imminent risk to the tech sector in the next 6 to 12 months. And within Asia, remember, we have also India that has been performing very well, and India is very decorrelated with the global business cycle. So in India, we are looking also at a post-COVID sort of re-emergence and domestic-led growth driving most of those returns. So I think it's a combination of factors, to be honest, and we are not going to see a reversal of these factors in the coming months. So we most likely going to enter into more bubble territory if things continue like this before we see some sort of pullback.
Chris, final thoughts from you?
Well, I would pick on what you said earlier about the liquidity, right? So people still have high level of confidence in the US government. People have high level of confidence in NVIDIA. So that's why they're buying more NVIDIA shares. It goes back to the deficit that I talked about earlier, that many domestic investors here in Hong Kong and China don't seem to have enough trust and confidence in the domestic market. And part of that could be cultural, because I have come across with many able fund managers who are very capable, but they may not have enough confidence. And then similarly, some of the engineers in China, some of the other, I think, technical professionals are also very highly skilled, but they don't have enough confidence. So I think one thing that is very key is Hong Kong government and also other policymakers are really trying to encourage more people to really, I think, see the Hong Kong market as a good investment opportunity. And hopefully that level of confidence will bring more investors back here.
Okay, well, thank you very much for your thoughts there. You heard Christopher Lee, who is Senior Partner at Farron, Augustine and Alexander Investments, Carlos Casanova, who is Senior Asia Economist at UBP in Hong Kong, and our US Economics Correspondent over in Washington, D.C., Barry Wood.
You're listening to Peter Lewis's Money Talk.
Money Talk.
Thank you for listening to Money Talk this morning. You can find more business and finance information from around Asia in my daily newsletter, which is at peterlewismoneytalk.substack.com. On tomorrow's programme, I'm joined by Enzio von Pfahl, Capital Preservation Specialist at Financial Shield, and Andrew Sullivan, founder of Asian Market Sense. And with a view from Japan is Nick Smith, Japan strategist at CLSA in Tokyo. Have a good Tuesday.
Money Talk.